Welcome to another Securinvest update. Now that things have settled after yet another financial year, I wanted to take the opportunity to provide a quick recap on the markets and go through some important changes that may impact you going forward. So the items I want to cover include a recap on the financial markets from the past 12 months, the changes to super contribution caps, claiming a tax deduction for your concessional super contributions, changes to how centrelink deem the income of account-based pensions, possible changes to account-based pension incomes, and reviewing your current mortgage. Last year was another good year for share market investors, with Australian shares up 12.7%, the US Dow Jones up 12.9%, and the UK FTSE 100 up 7.1%. There was some uncertainty after the recent election where consumer confidence subsided, however this seems to be on the rebound. Although it was a fairly tough budget, at the end of the day, the federal budget is like all our own personal budgets, and we cannot keep spending more than we make. And when tough decisions need to be made, there will be winners and losers, and unfortunately, not everyone will be happy. Anyway, enough politics. On to the interest rates. The RBA has kept the cash rate steady at 2.5% for 10 consecutive months now, and I can see it staying there for a little while yet. For the retirees, I know this is not good news for income that is being derived from your defensive assets, such as cash and fixed income. However, we've been more than compensated by the equities returns over the past 18 months, and now is definitely not the time to be chasing additional income. An appropriate risk strategy is essential to any retirement plan, and cash and fixed income play a big part in this. The Aussie dollar has remained resilient and rallied after a short fall due to our high interest rates compared to the rest of the developed world, continued demand for our exports, and the benign conditions in the US recovery. For this reason, the international exposure within our portfolios still remains predominantly unhedged to the US dollar. So what are some of the changes this financial year that could impact you? For those salary sacrificing, including those with a transitional retirement strategy or making personal concessional contributions, the concessional contributions cap for those aged 49 or over on the 30th of June 2014 have increased to $35,000 for the year. So you may need to review your contribution strategy. The non-concessional cap has also increased to $180,000 a year, or $540,000 over a 3-year period using the bring forward rule. Also remember that if you did make a concessional contribution for last financial year and you wish to claim a tax deduction, you should receive a form that you will need to complete stating your intentions to claiming a tax deduction. For those that are turning 65 or approaching pension age in early 2015, changes to the deeming of a superannuation pension income may impact on your centrelink age pension entitlement. From the 1st of January 2015, the deeming of these income streams changes, so it may be worth considering whether you should establish an account-based pension before the end of December 2014 if it is in your best interest. Those of you who have had an account-based pension and are receiving the nominated minimum amount, you may notice your monthly pension will increase. This will be due to the rising share market returns and the fact your overall account balance may have increased from last year, meaning as a percentage the minimum you need to withdraw has increased. Finally, something else for you to consider is if you have not refinanced or reviewed your mortgage or investment property loan, now is a great time as the banks are competing pretty hard and offering some pretty competitive rates. So please give us a call so we can introduce you to one of the mortgage brokers within our office. Once again, thank you for your time, and if anything I've mentioned may impact or concern you, please give us a call. I hope you find the content we are delivering of value, and don't forget to connect with us through all our digital and social media channels.